Welcome to this flight of the Retail Pilot. I'm your host, Ken Pilot, former CEO and current brand advisor, retail tech investor, and board member. I'm thrilled to share with you the insights from some of retail's legends and leaders, as well as my perspective on retail today. This podcast is sponsored by the following. January Digital is a marketing leadership company solving business challenges through consulting, media excellence, and actionable analytics for some of the most innovative, growth-oriented brands in the country, including Carhartt, Kendra Scott, Strivectin, and Steve Madden. Made up of January Consulting and January Digital, they offer strategic leadership services and full-funnel media planning, execution, and optimization, leveraging data to provide insights, yielding client success. Bluecore's software solution turns anonymous online shoppers into known customers and repeat customers. Bluecore enables retailers to personalize and optimize their email, SMS, and site marketing campaigns by delivering targeted and relevant messages based on where every customer is in their journey. Bluecore replaces annoying high-volume messaging with high-value messaging. Customers include Alo Yoga, Neiman Marcus, and Gap. On today's flight of the Retail Pilot, I have Simeon Siegel, Managing Director and Senior Analyst at BMO Capital Markets, specializing in retail and e-commerce. Simeon started his career at Goldman Sachs and has since worked on the number one ranked retail franchise at JP Morgan and Nomura Instinet. Simeon has been named a Rising Star of Wall Street by Institutional Investor, a Rising Star of Equity Research by Business Insider, a top stock picker by StartMine, and a top earnings estimator by Thomson Reuters and Refinitiv. He has worked on the Institutional Investor number one ranked All-American Research Team for Specialty Retail and the Wall Street Journal's Best on the Street list of top analysts. He is in constant dialogue with investors and C-level management across the country and industry, analyzing and advising on the ever-evolving retail landscape. He's a regular guest on CNBC and frequently quoted across media, including the Wall Street Journal, the New York Times, Women's Wear Daily, Business of Fashion, Barron's, and Bloomberg, among others. Simeon received his BA in economics and philosophy from Columbia University and is a CFA charter holder. He serves on the boards of Read Ahead and the Hebrew Free Loan Society and is vice chair of the UJA Luxury Division. Happy to welcome my friend Simeon Siegel to the Retail Pilot. And we are here in Las Vegas during Shop Talk and just thought this would be a great opportunity to talk shop. Simeon, welcome.
Thank you for having me. It's been a long time coming.
Yeah, I haven't seen Simeon since the TSA line and then flying on the flight together. Oh, and sitting next to him at dinner. Other than that, we haven't had any contact for a few months.
There is never a time when there's too much pilot.
I love it. You have an amazing resume. How did you navigate your way into the financial world and then ultimately pick the retail space to follow?
So it was actually all luck, as most things are. I was in school. There was a posting for analyzing retail stocks. I didn't really know what any of that meant. Someone sent it my way. I tried it and I fell in love with it. So it was this convergence of going into Wall Street, but at the same time stumbling into retail. I think thinking about it, the reason that it worked was I love the beautiful fusion between qualitative and quantitative. I love the reality that we get data that's sent our way with every transaction, and that data doesn't lie, but it's catering to one of the strongest powers in the world, what motivates people to part with their money. And so this beautiful qualitative understanding what goes on in retail, but then analyzing it from a quantitative perspective, that's been the dream.
And in terms of getting to that point, were you a shopper growing up? Did you like brands? Did you have an affinity for the space before knowing that that was the space you did want to pursue?
So what's really fun is when your origin story was there the whole time. You just didn't know it. It's like when the superheroes, you find out why they become who they are. And then you find out the people that are not superheroes can have origin stories too, because not everyone wears the cape, but it would look really cool. So my made up alternative origin story was that my grandfather, after he landed at Normandy and then came back, opened up more Slovene family shoes in the middle of Pennsylvania. And this was a man that was a retailer extraordinaire. This was a man that understood retail. It's all about the experience and it's all about the people, even more so than it is about the product. And he had great product, but he was all about making sure people knew when they walked in, they were coming for more than just getting their feet sized. And I grew up with that. And that's my pop-up. That's my son. My oldest son's named after him. And I would like to think, and I never appreciated it, that retail ran in my blood for forever. Now, did I like to shop? I didn't really like to shop, but I didn't mind if my mom dressed me. And so I remember, I think at my bar mitzvah, I think I had a 7-button purple zoot suit. And it was more of those things like, okay, that's what's on the closet. I don't mind wearing it. For my wedding, I had a Pegasus collar. Like, it's just one of those things where you just find yourself in a little bit of a different outfit. And so I don't know that I loved shopping, but I probably appreciated the byproduct of it.
Just so we can clear things up, your mom is not still shopping for you and dressing you.
Always.
Okay. Some things.
Is that not, am I supposed to let that go?
Well,
are you saying you don't like what I'm wearing?
She's doing a great job. Briefly describe for us your job, what it is that you do, what consumes your time.
So my job as an equity research analyst is to assess how publicly traded companies in my sector, in our sector of retail, do. So I effectively I'm a conduit, right? I write product for institutional investors to help them determine the health or lack thereof of companies in retail. There are people that do what I do for almost every sector. I do it with this sector for the reasons we talked about. What I think at its core, my job is to recognize that humans tell stories, not facts, and numbers, as long as they're not fraudulent, do not lie. Fraudulent, hard word to say. They do not lie. And so I'm going to take stories, strip them down to the numbers, and then recreate the facts and try and recreate that narrative. That's at the core what I believe my job is to do, but is written and verbal product with institutional investors to help them get comfortable with the sector.
You follow specific companies and then retail in general. How many companies specifically do you follow?
So it varies between 20 and 30, give or take. I have an incredible team who are the backbone of all the work and the backbone of all the ideas. And without them, I would not be able to carry that load. 20 to 30 is a lot more than it sounds.
Researching companies, staying current with companies, a lot of work. I assume it's every earnings call. And then there are conversations in between, which probably are a bit challenging because they're public companies. What does a relationship look like with a company to better understand them and put out product that you do?
Yeah, it's an excellent question because my job is to be objective. One of the knocks on my job is that we don't get our feet wet or hands dirty, whatever that phrase is supposed to be, and we judge from afar. I can't contest that, but what I would argue, what I would hypothesize or posit is that I'm one of the few that can actually be objective. No skin in the game means I can be objective. Being objective means you're not always going to sound nice. Sorry, we should always sound nice. You're not always going to be positive. And so building these relationships with the understanding that I'm analyzing a business and I have friends that aren't necessarily going to like what they're going to hear if the business is showing a downturn. And if it's showing positive, I'd like to think that friendship is not because of that. And so I've earned a lot of my relationships have come from harder conversations. They've come from really being transparent and thinking through and trying to challenge and probe. And again, trying to do it in a respectful, kind, and productive way, but recognizing that the results aren't always great.
Not an easy position to be in when you're building relationships. You want someone to take your call and to be viewed positively by those that you cover. Looking at 2024, we're almost through the first quarter. How do you see retail performing to this point and where is it going?
So what's interesting about retail, and it goes back to what we were talking about the reason I love doing it, is it's such an accessible sector, which means retailers tell their own stories, but we all tell stories about the retailers. Those stories are often one side of the pendulum. They're often to the extreme, and they're often not correct. And so we think about all the macro news. We think about all the fear. We think about all the conversations we see in the media. But then I'm going to look at the revenues and I'm going to see that this past quarter that you're referencing. So we're in the middle of the retail Q4 to Q3. So we're just ending an earnings cycle. And on average, those companies saw revenues grow 4 to 5%. That's the customer telling me they're buying on average, the gross margin was up 185 to 200 basis points. That's telling me that things aren't that bad. They're actually healthy. Now, the fact that the consumer's buying doesn't mean that they're spending healthily. They could be overstretching. That's another conversation. But what we know is we know that they are shopping. And so I think there's this dynamic right now where on average, 4 to 5, but the average is a dangerous comment, right? The whole don't go into a river that's 6 feet, average feet. Won't be very fun when you get to the middle. 60% of the companies saw revenues grow. Like, we didn't have every company grow. And what I think that says, and I think that's actually pretty constructive, is that for the first time since the pandemic, the last few quarters, we're starting to see divergence matter. We're starting to see divergence. We're starting to see execution matter. We're starting to see winners win, losers not so much. In the beginning of COVID, everyone won. Well, at the very beginning of COVID, no one won. Then everyone won because there was no inventory and there was stimulus and there was pent-up demand. And then after that, all of a sudden, the supply chain completely opened up. People had too much product and everyone started to lose. It was all about rising and receding tides, lifting and pulling back boats. You lost what made retail special. You lost the magic of really good operators. I think that's coming back. I think that's what we're seeing. And I think that's a good thing.
Going into the balance of the year, depending on the Fed moves, how do you feel about 2024 versus 2023?
So the depending on the Fed moves is a big caveat.
Is that a qualifier?
So it was funny because in November, so in October, the world was imploding. Well, in October, the world actually was imploding, but in October, in the retail world, all the macro fears made everyone believe we were back to retail is dead, the world is over. In November, companies started reporting and we realized, no, some bunch are doing pretty good. And the stocks took off, if we're using stocks as a measure. In December, the Fed conversation happened. And so all of a sudden, everything exploded. No company could do wrong because interest rates were coming down. Now, we did it. My team that I referenced before actually did a really interesting report analyzing who will benefit and who won't benefit from interest rates. It's a long conversation, but the gist of it is through COVID, a lot of these retailers became very cash rich. I don't know how your cash savings are doing, but it's nice when you can clip 5% in a savings account. The retailers saw a massive benefit from having a lot of cash, and a lot of them don't have debt that would benefit from a lower interest rate. It's either fixed or nothing's coming due. And so what we found is lower interest rates may not actually help the group as much as people perceive to be, because the whole higher level benefit would be it triggers spending. There's extra income in the wallet. But we just talked about how consumers are spending. The revenues are there. And so I think that ultimately the conversation became a little moot because in January, February, March, all of a sudden we don't know when rate cuts will or will not, or how often or how deep will happen, but it'll be something worth watching. So assuming that they do happen, assuming people come back to it, there'll be some nice euphoria, whether it's short-lived, whether it's right or not. But absent that, setting that aside, I think the fact that execution is allowing a divergence to occur means 24 should be better than 23. Not for everyone.
Picking up on the not for everyone, if you look at the different sectors, apparel, footwear, home, and then the different levels of spend, mid-range to luxury, who will be the winners and who will be those most challenged this year?
So I really like this question because I think it's a really easy question.
Thank you.
That is incorrectly used. So you thanked me too early. Well, you know better than that. So I think we like to create broad brushstrokes because they're easy. It's high income, it's a low income, it's a sector, it's a nod, it's on mall, it's off mall. The consumer doesn't work like that. And when we're seeing this divergence, we're seeing companies that sell the exact same thing to the exact same people, see exactly differing results. Coach and Michael Kors are a very good example. And so and then there's plenty more. I'm not to pick on Michael Kors. And so within that conversation, I think you need to be a compelling story. You need to have a really good sense of who you are, who your customer is. And that needs to be reciprocated. Your customer needs to have a very good idea of what they're looking for and what you offer. You mentioned home. For the most part, home is really challenged. Home goods, part of TJX, is killing it. Now, okay, she'll reply, oh, that must mean value's working. But that's not really the case either, because we're hearing that in certain instances where you're not seeing. And so I think that at the end of the day, we all understand high level beauty, athleisure, off price. Those are great sectors to be born into. Not everyone in them are doing well, and it's going to be a fight. But yes, I think there are certain sectors that are maybe at least more in favor, and then maybe have a little bit of structural benefit. But I don't think that means if you're not in one of those sectors, you can't do well. I mean, the teen retailers in the mall right now are as good as it gets. I don't mean they're at the peak. I mean, who would not want to be in their shoes right now? And who would have thought we would have been saying that 2-3 years ago?
We talked about this, but taking a look at Abercrombie's research and American Eagle's had good numbers. I mean, the kids are out there spending. They're spending money. They're spending their parents' money. And that's always, that it makes us feel good.
Says with pain.
That's what makes us feel good.
That's why we work.
But luxury continues to be extremely strong. And I don't know what potentially stands in the way of that sector, but that customer is still buying. The numbers coming out, whether it was from Prada or some of the latest from LVMH, really just knocking the ball out of the park.
So it is. And you will always have a great customer in luxury. But if we're being honest, it's nowhere near as good as it was, right? You think about during COVID. I mean, the article is talking about how it didn't matter how much you raised the price. Customers were coming back for it. And so I don't know if there's as much of an ease. Now, that raises the question of during the pandemic, was it the luxury customer that was fueling, or were there an incredible uplift of aspirational customers that found themselves flush with cash? Yes, stimulus.
I think it would be yes. And, clearly now with how well the market's performing, the psychological income of that 1% is much greater than it was 4 months ago. So I think we're going to continue to see a fairly buoyant luxury market, and we'll see how that trickles down.
Even Bitcoin's back.
Bitcoin's back. And, but the customer is tapped. The amount of credit card debt now is probably at an all-time high, much higher than it was during COVID. We were talking yesterday just to see how companies like Klarna and Affirm will benefit from that, because people will want to spread out their purchases over 4 months, 6 months, whatever the offer is. So it'll be interesting to see what happens with debt as the government is not pushing cash into people's pockets as it was during COVID.
I remember seeing an article, and I believe I saw this article, so fact check me if I'm wrong, talking about how putting the NPL options for milk in grocery checkouts. And again, I believe I read an article, so this is not me giving some really interesting analysis. But I mean, you have to ask questions there.
That's going down to the most basic level, and you would never think that that's where it would be used. That said, it is interesting when you look at the data, whether it's Klarna, Affirm, on some of the inexpensive product that's purchased. It could be at an Urban Outfitters. Someone's buying a shirt and they're spreading it over 4 payments.
Yeah. And I think it's the exact right. I think it's just as much of a question, just as much of a potential issue as much as it is a lubricant to spend. But I think that there's something about if you're splitting a quart of milk into 4 easy payments and you've used it up well before it raises a lot of questions that are very different on a normal credit equation. And I think that it perhaps portends for some greater concerns.
Look, it's another way ultimately to build debt, and it's another mousetrap. Let's switch gears. Anyone who knows Simeon Siegel knows that Simeon has themes. He has very specific themes. I'll call it your lens, that you begin to look at those out there that you cover and the industry at large. What are some of those themes that you're obsessing over this year as we move into 2024?
So I like that. And I like that you said this year, because I don't wake up trying to create a theme. We start doing research and we start pulling a string. We start saying, hey, that's interesting. Or, hey, that doesn't really sound like what everyone keeps talking about. And so one of the ones you and I bonded over was this notion that D2C is not all it's cracked up to be. We wrote a report almost 3 years ago now that was incredibly contrarian and had a lot of fights over back then. And now I think people are coming around to the fact that if you remove a middle person, you don't save on their cost. You simply absorb it by yourself. So that's a thing that will last, because it's funny, because it's the type of thing where everyone, even as people get more comfortable with it, the intuition is still to believe, the common sense is still to believe, no, D2C will always be better. So even people that internalize that it's not still ask that question. So that's something we'll continue to watch. This idea of divergence, this idea of...
And just to be clear, so when you're referring to D2C, that's as opposed to wholesale.
Correct.
Which, in a way, if you really step back or go up to 30,000 feet, why isn't wholesale D2C too? There just happens to be someone in the middle. From a customer point of view, if it's Nike and I'm buying it at Nordstrom, that's technically not D2C, but from a Nike perspective, or a customer perspective, it's from Nike through to the customer. So it's more semantics, but I'm agreeing with you that wholesale piece to the D2C eye is one that's, I think, critically important to growth as long as it's done in a measured way.
Yeah. Yeah. And strategic. You obviously have to have a partner that agrees with you. But the premise, direct through to the consumer, sounds good. But it's simply the idea that the notion was there's a third party collecting a toll in between you and the consumer. Remove that toll collector and you can own that extra dollar, those extra dollars. It's just not true. That toll collector is doing something.
That's right. And often the value or the earnings of your direct to consumer online business will probably come out to be quite comparable to your wholesale to the customer business if you start to look at all the costs that are being absorbed by the retailer through providing online product to the customer.
So it's an interesting rabbit hole because it's one of those instances where I have the danger and the benefit of not being able to see all the numbers. I see the totality. So I see the forest when I would love to climb and play with the trees. But when you look at the trees, you say, well, e-commerce has no labor. E-commerce has no rent. It has labor. It has no store labor. It has no rent. It is theoretically, it is lower cost than a store. It's more variable, so it's more akin to wholesale, to your point, and I'm booking the full revenue. So it should be much better.
It should be. At 30,000 feet, you would say, how can e-commerce sale to a customer be equal to, from a profit point of view, to a wholesale sale to the customer?
Yeah. And we said the same thing a decade ago to stores.
Right.
Because you took the same sale and you removed your rent and you moved your store labor. The problem is all of that sounds like it makes sense, but every company you and I know has been growing their e-commerce for the last decade. Most companies have been shrinking their wholesale exposure. And you know what's happened to operating margins? They're a lot lower than they were before any of this started. And you can say there's a lot of other aspects, but so when we try to isolate, so what we did in this report was effectively isolate what we could, and we showed that brands pivoting to direct did not see a relative increase in revenue, gross margin, operating profit, or operating margin. It just didn't happen.
Footnote C, Nike.
Yeah, exactly.
And they've reversed course.
They're in process of, I think, reversing course, or at least re-embracing also.
So that's one theme. What else are you theming on?
Yeah, so right now, the divergence is a big thing I'm looking at. Right now, I'm trying to take a step back, because when you talk about themes, the way I think about when I do a theme, it's more to say, where's the narrative not aligned with numbers? Where does the actual reality diverge from whatever rhetoric we're talking? And so right now, that execution is a perfect example, because there's this perception of, okay, it's high versus low. And it really isn't. So that's something that we've been really trying to keep an eye on and play with. Inventory is always, you think about the main KPIs that you and I need to understand, inventory, gross margin. Like, I'm a big proponent of the fact that people chase revenues, but revenues are a lagging indicator, not a leading indicator. The quality of sale is always what you want to focus on. The quality of sale will always erode before the actual sale because it's very easy to stuff if you need to. And so trying to measure inventory, trying to measure margin, trying to keep an eye on receivables. This is something we tend to look at very closely.
I'm a huge fan of GM ROI, gross margin return on investment, being a really important KPI for companies to obsess over. Because to your point, that is truly the quality number, the output of how well you are running your business.
Yeah.
Top line sales, you could buy them. Inventory, it could be bloated. GM ROI, the numbers don't lie.
Yeah.
Who are some of the winners out there now and maybe for this year that you're saying, they are doing some of the key things from your perspective, right, and winning with the consumer?
Yeah. So I'm going to answer this from a company perspective, not from a stock perspective, because it's a different question and a different job. So there, ironically or not, if you were to ask me who I think the greatest disruptor across all of retail was in the last, decade plus, I think TJX is one of the greatest disruptors in the sector. Now, I'm sure everyone listening is going to say, what is he thinking? They have almost no e-commerce. Their tech is just, de minimis. And yet, I believe it. Why? Because at the end of the day, this is an industry that needs to sell things, and all the other ways to get there, tech, channel, direct, international, they're all ways to help you sell things. TJX came and disrupted consumers' mindset. TJ made it okay, and actually a badge of honor, to get something valuable, cheap. You're not embarrassed to say you went to TJX. You're a fashionista.
It's almost where Target or Target
exactly.
was. It went from Target to TJX, Home Goods.
Exactly.
The thrill of the hunt, the fact that you can't get it online is almost a benefit. It's certainly a benefit to them.
Well, yeah, it's a huge benefit to them and to their vendors. So I think what was truly special about TJ and off-pricers, but TJ in general, specific, is that you and I know they're taking market share from the consumers. They're also becoming increasingly more important to the vendors. And the fact, I think they win because they have such a small e-commerce presence, not in spite of it. Because I'm a vendor, I know I can move product invisibly. I need to move a lot of units. I just dump them off there and they're gone. And you and I don't know that they were ever there in the first place. And so I think that this idea of retraining the consumer to view this as something to be proud of and giving the vendors an opportunity to move goods very quickly, very easily, and very invisibly, it's a very powerful thing. So I think that's going to continue. I think on the other hand, there's a few companies that are, again, in the athleisure space that are just doing a great job. And I think they're grabbing share. And I think that you can see whether everyone's walking around in joggers or not. Clearly this group, even we're at this conference, people are wearing real clothes again, but everyone loves comfort. And my jeans stretch really far right now. And so I think that there are certain companies that are really capitalizing and they're doing a really nice job growing. So that's going to get more of a nuance than anything else. But I think we wrap it up, like bring up the Eagles and you talk like the different mall-based retailers. And you're watching some companies that have been viewed as lost all of a sudden be on top of the world. And it just reminds you that these businesses, we think about everyone wanted SaaS and everyone wanted tech and everyone wanted recurring revenues. Retailers have better than recurring revenues. They have engaged revenues. Retailers start from zero. Brands start from zero every year. And yet they still manage to get that billions of dollars of volume every year. And these are the brands that people have called dead. Victoria's Secret, Under Armour, they're still selling $5, $6, $7 billion worth of product. That's powerful.
You mentioned Under Armour, so I'm just going to pick up on that theme. Kevin Plank is back in the mix. That company's had its challenges. They recently brought in John Barbados. Perhaps he'll reinvigorate the product. Can you speak about your vision, your view on where they go near term?
I think that Under Armour is a perfect example of a business that the media writes off as being dead while forgetting about the fact that they have $6 billion in revenue with a B. Under Armour is still one of the largest businesses in the history of apparel footwear businesses in the history of time. They're not dead. Now, I think if we pull on that string, what we begin to realize and appreciate is that revenues tell me how large a business is, but gross margin tells me how valuable a business is. Revenues tell me about a customer buy-in. Gross margin tells me about customer perception. Their grosses are lower than they should be. And so when I think about over-distribution, when I think about perhaps moving away from what made the brand special, you look at it and say, well, then that means that there's a lot of self-help opportunity, but they need to embrace it. And I think a hard part, one of those, it's much easier said from my seat than done from the operators, is that sometimes I think you could sell less, charge more, and make more money. That's a hard thing to swallow if you want to be a growth business.
I think that was a 2023 theme that's carrying over.
And by the way, in 2023 or 22, Under Armour generated cash for the first time in its history. They were allowed to shrink. COVID allowed them to shrink. And all of a sudden we watched the profitability come to the top. Now that theme, to your point, evaporated once the market started demanding growth again because the COVID silver lining faded. You weren't allowed to hide behind, I can be better, smaller. But now you're seeing the residual impact. Right now you're seeing a business that still feels like it's overselling and under-earning. And it doesn't mean it can never grow. But you got to get your house in order before you can protect it. And I think that's part of this conversation. And I think they have the ability.
As you're drilling into companies, is there anything that you are looking for relative to technology, their tech stack, spending, platforms being used, how they are advancing, that you think is very important to their positioning and potential?
So this is an area that I probably have less to offer in. So obviously we walk down the aisle over here and you can see in the Shop Talk exhibition hall, tech provider after tech provider, and the stuff they can do. And I know you're very well versed in this. The stuff they can do is magical. And from my perspective, it's hard for me sometimes to know who does what better. It's hard for me when you ask certain companies, who's your competition? We don't have any. It's like, well, that's what the guy in the booth next to you just said. And so there will be winners that are going to help you with inventory management. There's going to be different versions of AI that, is it the first time we said it, that are going to help you with finding your customer, maybe doing your copy. There's different things that are going to reduce my lead times. They're going to help my marketing. They're going to help. Like, there's going to be so many iterations of what the different versions of tech stack can do for you. It's not my area of expertise to say what each one of them is. What I want to remind you is that don't let it overtake your business. Use it to help. And so find providers that will reduce shrink. Find providers that will help with whatever version of marketing you want to automate. Your supply chain, right? Like, there will be so many different ways to allow you to sell more, to keep with Kevin Plank's theme, to sell more shirts and shoes. So that's your job. The rest is how you get there.
I think tech, certainly now more than ever, is at the forefront. I mean, companies that don't have the right product, the right technology isn't going to help them. But it's companies with the right product that can leverage technology to really accelerate their growth. And I think that's what's exciting for me, because I'm a product first guy, but then I do see the many tools that are out there, from what AI can do for you online to what RFID can do for you in stores, or a true omni point of sale solution, or how important performance marketing can be, and who should I use? I think the challenge is what you just said, referencing the haul of one vendor after another. There are so many platforms out there. It's not easy for a CTO or a team to take the time to take the meetings to understand who does what and does it best. It's overwhelming, in fact, but there are some true solutions out there that are making a difference in the business today, and it's pretty exciting.
And I totally agree. I'm not belittling tech at all. It's more that it's hard to identify which are the best. And particularly when you get blasted, very cold called by an army of people with promising to help boost my revenue generation and my lead targets, telling me that my retail business, Simeon Siegel's retail business, could really benefit from their ability to target the right customer. I don't have a retailer. So how are you're messing up your own avenue. And so it's like you sit through a lot of these things, so, okay, the bones are going to be there and someone's going to do this really well, and figuring out who it is isn't easy.
I'm going to ask you one more question before we jump into rapid fire. Is there a company objectively that's positioned itself above others from your perspective so far this year?
What I need to do as an analyst is to remove my own biases as a consumer. And so on Peloton, where we were very vocally concerned for a long time, on the last line of almost every report of the first paragraph would say, recommend the bike, not the stock. And so acknowledging that I loved what they were doing, but I thought it was overvalued. I thought it was going to be in trouble. I thought they were making the wrong decisions. So there's this interesting dichotomy of thinking through from that perspective. When I do believe that TJX will take a lot of share. Do I think what they're doing is remarkably exciting and innovative? No, but that's okay. And so I think that when I look, okay, TJX is running this business, taking share from their consumers and from their vendors. That is special. Doesn't mean it's going to be the best stock, but over a long term, I think it continues to compound. I think it continues to take that type of share.
Is that a comment also on the off-price space in general, or more specific to TJX within that space?
So this is a longer conversation, in my opinion. I think we use the off-price a little bit as a catch-all, and I think they're very different. I think that TJX doesn't sell cheap clothing. It sells expensive clothing cheap. Other off-pricers are much more discounters oriented around a price point. And so I do like the off-price model, but this conversation where they're taking share from vendors is much more of a TJX conversation. I think there's other off-pricers that continue to take share from the consumer and continue to become a more important part of their wallet, which is critical. I think TJ has the added benefit of becoming increasingly more important to very important brands and vendors.
Got it. And with that, let's jump into rapid fire. Are you ready?
Let's do it.
All right. If you could choose, would you prefer to be a rock star or a pro athlete?
Interesting. I'm staring at Mr. Rockstar over here. This one's easy. Baseball or basketball. I want to enjoy my success when I'm older. I want to be able to hear my grandkids, so I can't be a rock star, and I can't be a football. I'm going to get knocked around too much. So if I'm going to have a great career, I want to be able to enjoy it when I'm older.
Favorite streamed show?
Interesting. You've seen Dark on Netflix?
I have not.
So it's first season and a half are spectacular. I can't tell you anything about it because it's one of those where you have to just watch it, but it's one of dark.
Would you rather go back in time and meet your ancestors,
Okay.
or leap into the future to meet your descendants? What would you pick?
Well, I miss my grandfather, who we talked about at the beginning, very much. I would love to see him, as well as my grandmother. So that would be nice. But I'm going to go with definitely descendants, because if I went back in time, chances are I'm going to screw something up. And think about for the future is I could probably do more good and help my descendants. So at the fear, other than I would love to see pop up again and have a great retail conversation, I think I'd be terrified of somehow messing up the time space continuum or something or other. And we'll go and help out the kids.
If we were shopping together and got separated, what store would I find you in?
Oh, see, now you're asking me to pick my favorite children over here. No, I don't. You and I walk the malls. We don't.
This is a personal question. We're separated. You're shopping. So I can't find you.
It just depends what time. Every single store. Okay. If I've gone through my mall walk and I've done everything and I'm just hanging out, I'm probably in the Nespresso store. Can't walk by the Nespresso store without walking in.
Oh, that is,
You're hoping for something else.
Yeah, that's like Starbucks was busy.
No, Nespresso is
a great experience.
Experience like Nespresso.
It's like being in Europe without being in Europe.
Nespresso is this is a personal, I don't cover Nespresso. I don't even know if they're public, but Nespresso from a consumer's perspective has it right. I will walk in and just stand there and admire, and I will buy more pods, but it's one of those great loyalty without loyalty.
So have you, since we're in Vegas, already Googled Nespresso near me?
No, that's the beauty of it. I don't seek it out. If I'm walking by, if you've done your lap, right? I've gone through every store. Where am I stopping? It's probably an Espresso or a Warby. Those are my browsers. You didn't like that one. So far, I've done well with you. You weren't happy with it.
I was looking for a bag. I wanted to see are you going into Bruno Cucinelli? Are you going to Gap? Where are you going?
Everywhere. It's what time you come. But at the end of the day, I'll be there staring at people drinking espresso.
Got it. Who would you most like to meet?
Who would I most like to meet? I think realistically, I think you and I are very lucky because we've met and have relationships with a lot of our idols who have shaped this industry. And I think that is really special. I think being in the presence of people that can take a fantasy, that can create the magic of retail is really special. And that probably would have been my answer, but who would I want to meet? So I think that I'll take that to another corollary to people that we probably wouldn't meet, at least I wouldn't meet. And it's that same ability to create something magical that really sticks with you and just spend a day with them. And to me, J.K. Rowling, right? Like what Harry Potter has brought to my life, to my kids' life. We're now reading it there's just something about that. So I would say someone who can do that, someone who can take that story, something that you love and has transcended some of that magic, like that would be special.
I can see that you're a storyteller and she's an amazing storyteller. I can see the synergy. I can see why you would pick her as well.
Yeah, I think I like that one.
That's good.
Can you look that up?
I'll make that happen. And with that, we'll land this flight of the retail pilot. Simeon, thank you for joining me today here in Vegas. What a treat.
Thank you for having me.
Thanks for tuning in to this week's flight of the retail pilot. And please give us a review on your favorite podcast platform.